The closing bell has rung. Welcome to the Bulls, Bears, and the Bell Market Wrap. Let's break down the day.
Good evening. And if you were watching the screens today, you saw, well, an exercise in extreme patience.
Or maybe extreme nervousness.
Exactly.
Yeah.
This was not a day about making big moves. It was a day about holding your breath.
Right. So our mission for this deep dive is to break down what happened this session, Wednesday, November 19th, 2025. It was completely defined by what we're calling extreme bifurcation and macro tension.
You had traders who were just frozen. They were waiting for two massive events dropping right after the close.
Nvidia earnings and the Fed's FOMC minutes.
And that set up the whole theme for the day, a really high-stakes risk-on versus risk-off split. Capital was rotating aggressively ahead of that Nvidia report.
That one single stock risk.
And that positioning battle is what drove this huge index divergence. The market was narrowing itself down to just a handful of tech names.
Okay, let's unpack that divergence because the closing prices tell a story of a market that's, well, it's torn in two. For any active trader, this is a major warning sign. The rally is getting narrow, dangerously narrow.
It is. The contrast was just stark. You had the NDX, the Nasdaq 100, which was the clear outperformer. It managed to post a modest gain.
But let's be really clear here. That strength had nothing to do with broad market confidence, did it?
No, not at all. It was driven, 100% by optimism and positioning tied to that single massive bet on Nvidia delivering a huge beat after the bell. It was like a futures contract on NVDA's performance.
And the rest of the market paid the price for that optimism. We saw the DJIA, the Dow Jones, act as the clear underperformer, a really significant decline.
And that reflects broad-based weakness. Industrials, defensives, they were selling off. Money was leaving the old economy names.
So what about the benchmark, the SPX, the S&P 500?
It was sort of caught in the middle, ended up mixed, flat to slightly down. The sheer gravity of those magnificent few tech stocks was fighting against this really powerful weakness across all the defensive sectors.
So the headline number was masking the pain underneath.
Totally. Some reports show that if you stripped out those few names, parts of the S&P 500 were effectively down, 1.7%. It confirms there was a lot of hitting pain today.
Okay, so if the Dow is sinking, which signals recession fears, well, the Nasdaq is barely holding on because of one chip maker. What does that tell you about systemic risk?
I think what's fascinating here is just how fragile it all is. That split between the DJIA and the NDX is a massive red flag.
Right.
It tells you that the entire rally's viability is now hinging on a tiny cluster of AI-related stocks.
Yeah.
If that single point of failure Nvidia had disappointed, wow, the systemic risk would have been enormous.
The whole market's near-term fate was on a single earnings print.
That's it,
Yeah.
which sets the stage perfectly for this pre-close gridlock. We had these two monumental drivers. First, the Nvidia AI thesis, the big one.
The high beta event.
This wasn't just another earnings report. The Street treats Nvidia's fiscal Q3 2026 results as the single most important proxy for the entire AI capital expenditure cycle.
So the thesis is, if companies are still spending on GPUs, the growth story is intact.
Precisely. If they're spending, the secular growth story is validated for years. If they blink, the whole tech narrative it collapses.
And what was the mandatory trade going into the close?
Institutional desks were basically forced into one setup, long NDX exposure and often short the VIX. They were betting the market would absorb the news in a positive way.
So consensus long trade.
A widespread conviction for a beat and a raise, and that's what kept the Nasdaq looking so unnaturally strong all day.
Okay, now for the other driver, maybe the more complicated one, the FOMC Minutes division, which hit right at 2 p.m.
And this just raised a massive question mark over the dovish pivot the market had priced in. We were expecting certainty, and instead the minutes revealed a notable division among Fed officials.
On the timeline for a December rate cut.
Yes. While most of them supported future rate cuts, eventually, the fact that there was open disagreement just shattered the consensus.
And a split narrative is poison for certainty. What was the direct impact?
It's twofold. First, it killed the idea that a December cut was a done deal. Second, it increases uncertainty for the path of rates into early 2026. This makes the December meeting live again.
Meaning more volatility.
Guaranteed.
Yeah.
And that's brutal for any sector that depends on cheap borrowing. Think housing, regional banks, longer duration bonds.
We also got a pretty mixed signal this morning from the trade data. It looked good on the surface, but...
Yeah, the trade deficit narrowed in August. And that sounds positive, right? A narrower deficit technically boosts GDP.
But the devil's in the details.
Always. If you dig into why it narrowed, the picture gets muddy. It was mostly driven by a sharp drop in imports, and that's the subtle warning sign.
A drop in imports suggests we're buying less from overseas, so weakening domestic demand.
Exactly. Currency traders are watching this very closely. It's a sign the consumer might be running out of steam, which really casts a shadow over that whole soft landing story.
Okay, let's shift to the market internals, because despite the Nasdaq's optimism, the broader feeling was definitely risk-off. The S&P closed down for its fourth straight session. That tells you something.
When you see that, you know the professional money is hedging. And the technicals, they were screaming caution. Let's start with the VIX, the fear gauge. It closed stubbornly near $24.50.
In simple terms, what does a VIX at 24.50 mean for our listeners?
It means institutions are paying a huge premium for insurance. They're buying protection against two specific things: a hawkish surprise from the Fed minutes or catastrophic NVDA miss. They were priced for a major event.
Then there's the TRIN indicator. The inferred reading was over 1.2.
Right, the ARMS index. So 1.0 is neutral. When you see it well above that, like 1.20, it confirms a strong bearish bias.
Meaning selling volume was dominant.
Overwhelmingly so. Even with the Nasdaq positive, the overall market posture was bearish. There was distribution happening under the surface.
And finally, the NYSE readings. They were all over the place.
Incredibly choppy. It just showed a total lack of conviction. You'd see these wild swings, deep negative readings, down near -1,000.
Followed by short-lived rallies.
Exactly. Spikes up to +800. That kind of choppiness just shows you traders were nervous, reversing positions on a dime ahead of the big news.
Okay, moving to sectors. The rotation today really tells that story of a flight to safety. Where was the money hiding?
The leader of the day, signaling maximum fear, was utilities. XLU, no question.
The classic defensive play. A bond proxy.
It's the primary safe haven. When investors are worried about volatility and recession, they park their cash in XLU for the stable yield. It's the purest defensive signal you can get.
And on the other end, the laggard was consumer discretionary, XLY. It took a real beating.
Yeah, XLY got hit with a 1-2 punch. First, the fear that the Fed will keep rates high, which crushes consumer spending.
Right.
And second, just general risk aversion. When volatility is high, portfolios cut exposure to things like high beta retail and leisure stocks first.
But our key focus was information technology, XLK. It wasn't the worst performer, but the action inside the sector was critical.
The price action in XLK was all about the NVDA overhang. This wasn't organic trading, it was high-volume positioning. The whole sector felt like a betting parlor.
Coiled for a huge move one way or the other.
Exactly. Either an explosive launch or a deep correction, all based on one company's results.
And then the bell rings, the news drops, and we get the after-hours shockwave. The tech relief rally the market was so desperate for.
And this is where it gets really interesting. Nvidia delivered the catalyst. A massive top and bottom line beat, and incredibly strong Q4 guidance.
They didn't just beat, they blew the estimates away.
They did. This validates the entire thesis about exponential demand for AI infrastructure. The market reaction was immediate. NVDA was significantly higher, and it pulled the entire Nasdaq 100 futures complex right up with it.
So the AI trade is vindicated.
Absolutely. We should expect immediate relief and a lot of short covering in other semiconductor names. AMD, MU, SMCI, they're all going to move with this.
But it wasn't just Nvidia. We also got a supportive report from Palo Alto Networks, PANW.
Right, and this is a critical supportive signal. PANW confirms strong performance and raised your guidance. It tells you that corporate IT spending on non-discretionary cybersecurity, it's still an absolute priority.
So cybersecurity is acting like a defensive growth basket.
That's how professional money is going to treat it. So the immediate implication here is that this positive tech catalyst is going to supersede all that macro fear we talked about.
The narrative has pivoted.
Instantly. The immediate trade for Thursday's open is a substantial relief rally. People will be chasing gap fill trades to catch up.
Okay, that sets up tomorrow perfectly. What are the key technical and macro items our listeners need on their watch list?
Technically, you have to watch the 20-day moving average on the Nasdaq 100. That's the first major resistance test on a big gap up.
A key level for sellers to re-engage.
Exactly. If we can break and hold above that, it confirms the recent correction is probably over.
And what if those after-hours gains just melt away before the open?
That would be a massive bull trap. The worst-case scenario. It would signal that the macro fears from the Fed minutes are still the dominant force.
We also need to watch cross-asset implications. bonds specifically.
Absolutely. This risk-on rally should put upward pressure on Treasury yields, so you have to monitor the 10-year Treasury yield.
What's the warning sign?
If stocks are flying higher but the 10-year yield drops sharply, that's a worrying decoupling. It means money is still flying back to the safety of bonds despite the good tech news.
And we can't forget the FOMC Minutes debate is still there, just on the back burner for now.
It is. You need to check the commentary overnight. See if any hawkish surprise from those minutes is strong enough to temper this NVDA enthusiasm.
Finally, what's on the economic calendar for Thursday?
We have some high-impact reports. Jobless claims, manufacturing data, and the one I'm watching, the 30-year mortgage rate release.
Critical for homebuilders and regional banks.
Very. If that rate ticks higher, it could dampen this post-NVDA rally pretty quickly.
Which brings us to our final takeaway. The market has executed a pivot. In just a few hours, the narrative shifted from macro fear to micro growth validation.
And the crucial tension for Thursday's open is this. Can the incredible strength from just two stocks truly override the deep fundamental division we saw in the Federal Reserve minutes? The micro looks great, but the macro landscape is still incredibly complicated. That's the question for tomorrow's trade.
That's a wrap. Thanks for listening to Bulls, Bears, and the Bell. We'll see you at the open.